Getting ahead of the Fed with the annual conference kicking off today in Jackson Hole, Wyoming. Markets are pricing in continued hawkishness coming from Jay Powell and company, but rates are only half the picture. What is the Fed doing about its soaring balance sheet? For more, let's bring in Matt Maley, Miller Tabak, Chief Market Strategist. Now, as we know, we have seen the wind down of quantitative easing, but in terms of shrinking of the balance sheet, that's been less of part of the conversation as of late, Matt. So do you expect to get any kind of commentary around that?
I would think we would, Julie. I mean, it was funny because in the last press conference, at the July meeting, Powell did address it very quickly. He didn't get any really follow-up questions, but he did say we're going to get more aggressive in shrinking our balance sheet. And, I think most people kind of took that as like, oh, okay, fine. But we've known that because they're going to go from $37 billion a month. $47 billion a month, June through August, and double that up to $95 billion a month starting in September. However, they have not shrunk the balance sheet anywhere near as much as they had said they were going to in the first 3 months. Does that mean they have to play catch up? I mean, these monthly numbers that they gave, whether it be QE or QT, were always average numbers. Sometimes in QE they would go a little less, then the next month they go a little bit more. Does this mean they're going to have to go a little bit more? If that's the case, and we do start to see the balance sheet shrink a lot more, that takes takes even more liquidity out of the system, less liquidity for risk assets. That could present some problems.
What do you believe that the markets would price in that event, and as the Fed, as we're going to see exactly what that slower pace of tightening might look like?
Well, Brad, the thing that we have is that, the stock market is still, it's nowhere near as expensive as it was at the beginning of the year at 22 times earnings, but it's still very much at the high end. 18 and a half times earnings right now. It was 19 last week. It's hard to have that keep that kind of elevated valuation levels when you don't have that excess liquidity. And so I do think that people will have to, if nothing else, we'll have to see multiple compression, and that's going to bring the stock market down. And that's assuming that we don't get any decline in earnings. If earnings do come down a little bit in the second half, and estimates for 2023, that's going to create even more headwinds.
Matt, we're starting to see a breakdown, a lot of big cap tech names after this rally. One being, of course, Apple. Do you think these stocks are going to get defended?
Well, it's going to be Apple in particular is going to be very interesting because it did get overbought. You look at, some of these people, if you look at what we call MACD charts, and they're a measure of momentum, and they've lost some momentum. But, they've had these great runs. So the fact that they might pull back a little bit wouldn't be the worst thing in the world. And I do think they'll be defended to a certain degree. But if interest rates are going to move higher, that's going to be tough. Now, for Apple and specifically, though, they've got a big announcement coming up, a product announcement coming up. I think it's September 7th. And the stock tends to rally in front of those things. But it's funny. I've spent a lot of time this summer. This is anecdotal. It's not scientific. But I've asked dozens and dozens of people about whether their smartphone, are they going to upgrade? And they're like, geez, my smartphone is really good the way it is. I don't know that we're going to get the big surge. We certainly do well, the big surge we've seen in the past. So I guess my point is, I think it looks like Apple wants to come down a little bit, and these big tech stocks, I think, are going to cause see some more headwinds because we've seen this change in trend in interest rates, and they weren't paying attention to that for a little while, but now they have more so in the last week or so, and I think that could continue.
Even with new products that may come out from the big tech companies or deep discounting that some of the retail companies may do, what's there to say that the consumer actually wants to continue to just not throw money at these companies, but to spend in a time where they are looking across all of their finances and trying to best understand where they need to spend versus where they would like to spend, and are deciding to say, you know what, on the discretionary side, we're seeing this show up, that they're going to pull back?
Yeah, Brad, I don't want to sound too overly negative here, but this consumer thing is a big concern of mine because oil prices have certainly come down, gasoline prices have come down, but they're still much higher than they were last year. But the key thing is on the food side is food prices remain high, and they're going to go back up because natural gas is vitally important for fertilizer, for making fertilizer. Those prices are going to remain high. That's going to keep food prices high. We're talking about planting planting seasons. If natural gas stays high through the end of this year, that means fertilizer is going to be high next year. We have what 60 some odd percent of people, the low 60s, living paycheck to paycheck, and if they're paying a lot more to put food on their table and to pay for gasoline, that has to cause them to pull back. And we're seeing that, of course, in the higher numbers on credit card debt and such. At some point, they can't just keep adding to the credit card debt. And again, that's another concern for me.
Ooh, all right, Matt. I got to go. I don't know. Put a cool towel on my head or have a drink. I'm not sure what. Matt Maley, Miller Tabak, Chief Market Strategist. Thank you so much. Appreciate it.